Are we about to see a Russian silver squeeze? Before we come to the Russian silver squeeze, we have some breaking news. So we've got some US senators wanting to freeze Russia's gold reserves, so not allow them to sell their gold. Now, you and I knew that Russia were never going to be selling their gold reserves. Why would they? They've been buyers of gold, not sellers. And even Goldman Sachs here says Russia's central bank unlikely to sell gold reserves. Russia's central bank is unlikely to sell its gold reserves to support a drop in the ruble amid sanctions, according to Goldman Sachs Group. Their points here: the difficulty involved with liquidating gold reserves and the presence of a large current account surplus means Russia will likely focus on capital account restrictions to manage the ruble exchange rate. And this is from the three analysts at Goldman Sachs in a report dated March 4, citing research by the bank's economists. Capital restrictions are a more effective tool at managing a tumbling currency than gold sales. Selling gold in any meaningful quantity will require finding a buyer willing to transact with the Russian central bank, thus facing the risk of violating sanctions. As the central bank now has limitations with accumulating G7 assets, may end up buying significant amounts of domestically produced gold, around 300 tons. Exactly. That's exactly what we've been arguing, what we think is what Russia would be doing. And return to being a large purchaser of bullion after pressure on the ruble recedes. Note, Russia has more than 2,000 tons of gold at the end of January, according to data from the IMF, accounting for just over 20% of its reserves. It's the fifth biggest sovereign gold owner globally. And with that, Mr. Zoltan Pozsar has come out overnight and released this, Bretton Woods 3. He says, we are witnessing the birth of Bretton Woods 3, a new world monetary order centered around commodity-based currencies in the East that will likely weaken the euro-dollar system and also contribute to inflationary forces in the West. A crisis is unfolding, a crisis of commodities. Commodities are collateral. Collateral is money. And this crisis is about the rising allure of outside money over inside money. Bretton Woods 2 was built on inside money, and its foundations crumbled a week ago when the G7 seized Russia's FX reserves. This beautiful paradox of linear rates, the stuff you trade and I write about, is that you need to think linear to find relative value most of the time, but you have to think non-linear to recognize and survive regime shifts. We are seeing a regime shift unfold in funding markets currently, which as always will pass, and a sea change in inflation dynamics and FX reserve management practices. We have two convictions today. First, we've got the June FRA OIS spreads, which can widen more to at least 50 basis points, both due to funding premiums driven by commodity prices in the market taking out Fed hikes. And second, it's a good time to get long. Shipping freight rates. Yes, freight rates, which at the current juncture are linked to geo-monetary dynamics. Freight rates are the price of balance sheet for commodity RV traders, the commodity trading houses, and for sovereigns that can take the risk of moving and storing subprime sanctioned commodities. First, funding. Since the start of the conflict in Ukraine, spot US dollar LIBOR, FRA OIS, and FX swaps have been showing signs of stress. Not much, but we hear two things from funding desks. Cash is bid, and term cash is hard to come by. Normally, where overnight points trade in the FX swap markets determines how the rest of the curve trades. Low premium in overnight space mean low premium in term space. But these aren't normal times. We have a crisis of sorts unfolding. And in a crisis, like in 2008, everyone lends at short maturities, and the collapse in overnight premium is at the expense of term premium. In a crisis, term funding premium increase on the back of compressed overnight premium as opposed to decline as they normally would. Who drives the bid for cash, i.e. whose bid is driving term funding premium in this environment where lenders are less willing to lend cash for longer tenors? The commodities world. For three reasons. First, non-Russian commodities are more expensive due to the sanctions-driven supply shock that basically took Russian commodities offline. If you are a leveraged commodities trader, you need to borrow more from banks to buy commodities to move and sell them. And from this chart, US credit markets are starting to show signs of strain, although it's a far cry from March 2020 type disruption. US investment grade spreads widened the most since June 2020 yesterday. The traders moving away from credit risk even in the face of strong balance sheets. So watch this very closely. And coming in from Kitco News, LBMA suspends 6 Russia gold and silver refiners from good delivery list. The global precious metals market could see another significant disruption in its supply chain after the LBMA has suspended the membership of 6 Russian precious metals refiners. In a press release published Monday, the LBMA said that in light of the sanctions and to ensure an orderly market, it has suspended the following gold and silver refiners immediately. These 6 refiners will no longer be accepted as good delivery by the LBMA until further notice. And you can see the 6 refineries there. Now, we're also hearing talk that that Australia's largest refiner, ABC Bullion, is out of stock. Also, First Majestic Bullion Store's out of stock. JM Bullion is out of stock. However, all of them have said that they have ordered more from the mint, or they are refining more gold and silver. So they do say that stock is on its way, but we are seeing a big uptake in the metals again. Now, with Russia, now there's debate as how much supply Russia actually, their annual production in terms of, the market cap. And it ranges between the 4th and 6th largest producer of silver in the world, depending on who you talk to. And that ranges between 42.5 million ounces and 70 million ounces a year. Now, if Keith Neumeyer is right and the actual silver supply each year is 800 million ounces, then we're looking at Russia providing anywhere from 5.3 to 8.75% of total market supply of silver. Now, I've shared this tweet from Peter before, but when you look at the percent of total new mine supplies, Russian precious metals production for silver is 12.5%. So whether you take the lower amount of 5.3% of total global silver supply, or you look at 12.5% as new mine supply, we're going to see a lot less silver in the market. Anyway, guys, what do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it, guys. Take care, and I'll see you all again on another episode of Finance Uncut.